Good morning and welcome to You're 18, Now What? Thank you for joining me on this great Tuesday. I'm Dr. Catherine Gilstein and I am looking forward to empowering you with information about financial literacy and economic empowerment. I will continue to post on the second and fourth Tuesday of the month, but occasionally we'll add episodes in between for you. Today I have with me Zdenek, who is the author of two books. So Master Your Cash Flow and Master Your Business Cash Flow. So we'll definitely get into those. And also startup of Cake Club and how AI is reshaping budgeting. And I know we've done a lot of stuff about AI recently and the importance of it. So we're going to try to touch on a couple of different things, his books, time, compounding interest, cash flow maximization, and go from there. So welcome, Al. Thank you so much for joining me.
Catherine, it's a pleasure to be here, especially with a fellow Philadelphia.
No,
I'm sorry.
no,
Brooklyn.
No. New York.
I know New York.
So, talk about how you started the book. So you had Master Your Cash Flow first, and then Master Your Business Cash Flow. So talk about mastering cash flow. How did that come about?
Master Your Cash Flow, basically, I did that. I wrote that based on my 35 or so more years of being a financial planner and wealth advisor. I really wanted to put into a book our approach to financial planning, which is a cash-oriented approach. Most planners out there basically are goals-oriented. You go in, they say what kind of goals you want, and then there's buckets to save for all those. Okay. We took a different approach. We think the goals are very important and to have those amounts, but we took a cash management approach, which means you look at everything. From their insurances to their wills, which I know planners do, but we even go into their careers, how they earn money, all the things and we're looking for cash flow. And the reason we're looking for cash flow is you get more cash flow that you have to save, well, then you save years of life in having to work. You get to your goals, you get to your financial plan sooner, you work less in life. And we like to do that, and as you live life along the way, we're not sort of scampers that, stop that Starbucks coffee, whatever. We'd like you to live life along the way because life's hard enough, and saving money's hard enough, and budget's hard enough. Well, why not reward yourself along the way? But make smart financial decisions. So I wrote that book that basically looked at how we had been advising clients for the 35 years that I was in the business. And then I wrote the business one because, as you know, there's a different mindset and different variables that a business owner has to look at versus an individual person.
Absolutely. So separating, the personal and the business, that can definitely be challenging. So what's important about, and I talk about it in my book as well, time and compounding interest. Give us an example of what you used when you were doing wealth advising.
Sure. Well, I have to admit, I started life as a CPA, and I thought I knew everything about finance. And it wasn't until I got into wealth management I realized, my God, I never really appreciated compound interest. And it's really funny. Einstein, as you probably have heard, he's supposed to have said it's the eighth wonder of the world. It's one of the greatest discoveries that humans have discovered over the last 100 years. And what I learned is that most people, when you say compound interest, they intellectually know what you're saying. They just don't believe it. Right. And so they make decisions that don't take fully advantage of it. And I think it's because human beings tend to be lateral, thinkers, straight line thinkers, linear thinkers, and compounding is exponential. We can't, for example, if you're going from Philadelphia to New York, you see that in a straight line, but you don't see all the roads and the things in between. And that's what that is. So I found that in my working with people is that they don't really understand it. So an example I would give is one that was in Warren Buffett's biography about 20 years ago. And Warren Buffett was heard to go around sometime when he was trying to make a decision. Why would I take a $300,000? Why would I make a $300,000 haircut? And so I looked into that, and what he was really meant was that small things mean a lot over time. So for example, a haircut, if you had a choice of getting a $50, $60 haircut or a 25, and you save that $25 or $30 over time, and then your spouse did it, and then you save that money into a 401k and got the tax advantage, that's $1 million decision over 30 years.
Right.
And by the way, that's $1 million. It's $1 million decision. That means you don't have to work 1 hour longer, 1 year longer. You don't have to have a pay raise. And it's what I call shuffling paper. You want to make sure that you're looking at things like that, whether it's leasing or buying a car, or how you're stretching out, how you're paying your home mortgage or not. Is it better to save that money now and have compounding, make it, again, another $1 million decision or not? So I try to bring those decisions back to, like, when a person I was with in planning, if they were deciding to, again, lease or buy, and it's a matter of $100, how did that mean? What did that mean over a period of 20 or 30 years? And as you know, those can be really big numbers. So that's how I used to approach my clients.
No, it makes total sense. What I found is that, and I do mention it as well, is that people are very good at saving for the short term. So
Yes.
if you say, let's go away for the weekend in 3 months, like, okay, no problem, I'll put away money, we can go away in 3 months. But when you talk about saving for the long term, I think that's where that linear thinking comes from. And they just see it straight ahead instead of that exponential curve that time and compounding interest does have. So I think that's the difference there. So
Well,
saving for the short term is easy, but for the long term, not so much.
I think another thing too is that, let's say you're sitting with a client, and you have many times, and you say, okay, for you to be financially independent, it's going to take, you have to have $3 million. And they have very little now, or they have some, but they're thinking, how can I turn 200,000 or 300,000 into 3 million in 20 years? Because again, that's compounding, but they can't do the calculations. So sometimes when they're not sitting down with someone knowing that, but they know how much they need, they think, I'm not going to make this, so why not party? Right. Why should I save? I'm not going to make it anyway. That is for the rich people, that's not for me. So you have to slowly teach people that way, that again, those small savings things, if you do it over a long term, not short term, can mean a tremendous amount to your financial plan.
Yeah, I think consistency is key. And I stress, if you don't have a lot now to start with, especially people that are just starting out, even if you put something as small as $10 away a week, it will add up. And then it becomes a game. You put in $10, like, oh, I got to get it to 100. And once it's at 100, it's like, oh, I got to get it to 250. I got to get it to 500. I got to get it to 1,000. And then you just see it growing and growing. And I think that's what people, a lot of people that I come across, they can't see that long term. And it's like, well, it's only $10. It's only $10. And I'm like, patience, consistency, and that's going to build it. And you will see that money grow.
I couldn't agree with you more, especially, again, starting off, even if it's a small amount, $5, $10 a week.
Right.
And I like the fact that you make it a game. I think that's very important, because the game is, well, I can do it this month. How much more the next month? More than that, more than that. Can I find another way to save more? I think, again, what you do, you make it more aware of also trying to find some more sources of money.
I agree. Totally agree. Any other tips for cash flow maximization?
Well, I'll say one thing. There's many things when you talk about that. And I think the first thing is to know what you have coming in and what you have going out. You can call it budgeting or whatever. I mean, it could be just where you look at your checkbook at the end of the month. This month, this amount came in, this amount came out. Know where you're starting from first. And if you have like excess money coming in, well, then you have the ability to save it. Now, next step is now maybe look at what you spend. Look, because I'm sure we've all done this, going on vacations, going out shopping, and you don't watch things sometimes, but going back and looking at your charge cards, looking back and see, do you really need those extra channels on cable? Do you really need those subscriptions you have? I mean, looking at your spending, it may be a surprise and get you more in control that way. But you and I talked a little while before. I'm not a big believer in like punishing people. Like I don't want people to stop if they enjoy a Starbucks coffee or a latte every day.
Absolutely.
That's important because life is hard enough, and you're in a long-term plan. You want to enjoy life along the way. But most people, again, look at the first thing is how can I spend less? And again, you can do things like restructuring mortgages, restructuring debt, all those things to free up cash. But I also like to have them look at how am I earning money, right? Well, how am I earning it? In the job I'm in, am I due for a raise? Is there a better position elsewhere? If you're self-employed, there's a big difference sometimes. If, let's say, you have a consultant, and this is a true example. I had a consultant who was, let's say, charging $100 an hour, and they were having problems saving or whatever, but they were busy. I said, make it $125.
Increase your price. Absolutely.
They looked at me and said, I'm going to lose clients. I said, try it on new clients. They started trying it, and then they applied it. Well, they increased their income 25% without having to work another hour longer. Right. And without having to punish themselves. So I think you look at those things too. Again, the normal things is that if you are saving, make sure you put them in your 401k first if you have that at work. If you're not filling up your 401k, that's a cardinal sin because you're missing out not only on the tax deferred, you're missing out on possibly a match.
Possible match, right? And if they're matching it, that's free money. Why would you give up free money?
Never give up free money. That just pushes you ahead without working harder in life. And then, of course, we might talk about this more later, but IRAs, which one are you going to open up? A Roth, a traditional? But always go for tax deferred. My cardinal rules when you're saving, always put them in tax deferred accounts first or tax free. And then if it can't be, make it tax free, then tax deferred. And then finally get down to taxable accounts, but always fill up those other ones first. And so that's how I would approach it when you're trying to maximize. If you get into what you called the game before, like constantly looking at not only what you're spending but what you can earn. I think that you make it a game, and again, what we're out for is making people more aware, just more awareness of how they're spending, what money is coming in. That's how you eventually, through this game, maximize your cash maximization.
I think one of the difficulties now is that there is just so much technology out there, and it's very easy to just order something on your phone, go to the counter, just tap to pay, and you're not really realizing what's going out of your account. You know it's going in because you get your salary in, but you're not realizing what's going out of your account. And I think an important piece is, budgeting, cash in, cash out, however you want to look at it, but budgeting changes over time. So you can't just, set a budget today and then have that same budget a year from now or 6 months from now. That needs to be constantly evaluated. What are your needs? What are your wants? What can you, what are you using? What are you not using? Basic things like if you have stuff in your house and, you're old enough to remember George Carlin, right? Your shit is somebody else's stuff. So if you're not using it and you're not, sell it. Facebook Marketplace, eBay, there's so many online sites to sell your stuff to get, that extra money. And if that's not money you need, you could just take that and put that away. So there are things out there, but I think it's a constant. And as important as money is, nobody wants to talk about money. And the lack of financial literacy in the country is ridiculous.
Well, there is none.
Exactly. So, like the more that I talk, the more that I have interviews, the more that I meet with people, it's just getting that information out there, especially to those that don't have it. I do want to go back to traditional and Roth IRAs. and the importance of those, of having that in your portfolio, because that's something that you can start with your first job out of school, and maximize on that as something that, I mean, when you're 22, you're not thinking about when you're 62, but if you can put that money away, that's 40 years of money being put away. So thoughts on
You're
that?
right. Well, I
Mm.
think that, again, going to what you said, financial literacy, we're not taught in high schools, college. We have brilliant students graduating school, getting great jobs, and they waste money. They don't know what, they hardly know how. Well, no one writes a check anymore, hardly, but they can't do that. Know how to get a loan, whatever. So that is something that I think it's great. You're supplying more financial literacy to young people, and we so need that. And there's such
Thank
a
you.
demand for it. There's such a demand for it. But let's go to the question about the 401k, excuse me, the IRAs. IRAs are, again, I would suggest if you're working, if someone's working for someone and it has a 401k, that's the first thing you're going to save in. That is much better than any IRA that you can have. However, the next thing, once you fill up that 401k, is to now choose
Let
an
me just
IRA.
interject it. Let me just interject a second for the listeners out there, is that 401ks differ by company. So it could be a 401k if it's corporate, it could be a 403b if it's nonprofit. It's the same type of account. You're putting it away. It's tax deferred. So meaning they're taking it out of your account before they charge you with taxes. So it is a tax benefit for you. All companies are also different. Some match a dollar for a dollar, some match 50 cents on the dollar, some match up to 3%, up to 5%. So definitely look at that when you get hired in the benefit package and maximize that as much as you can. Go ahead, Al.
Very good point. And an
Mhm.
additional point to that, keep in mind that most of those companies, they will supply you with platforms on how to invest, and they normally will have
Absolutely.
either better fees or cover those fees as part of the benefits of 401k. So you get like a lot of benefits by going to your 401k first.
Mm.
However,
And then if they have dividends, those dividends are being reinvested as well. And that's also adding to the portfolio.
right, so a 401k, or if you're self-employed, some sort of pension plan is the most powerful thing you can invest in. And I would encourage that's the first thing you look at. And then the next one is an IRA. And there's two types of IRAs. There's a Roth IRA and traditional. And the biggest difference between them is that basically in a traditional IRA, you're looking at deferred taxes. Whatever you put in there, you're going to eventually pay taxes on when you withdraw. And if in a Roth IRA, whatever you put in that is going to be tax-free when you withdraw it. Now, of course, with traditional IRAs, depending on your income, you may be able to deduct that. And most beginning workers and young people can probably deduct what they put into a traditional IRA. But eventually, there's an income cutoff. With a Roth IRA, there's a ceiling, or that once you reach a certain income, it's in the 140, 160 range, depending on married or filing joint, is that then you can no longer have a Roth IRA. So if you can qualify for a Roth IRA, I always go there first, because the tax savings, I think, is much more modest as you're put into a traditional, but having everything grow tax-free and tax-free when you withdraw is very, very powerful. I think that if you get to a point that you can't give to a Roth IRA because of income limitations, then you give to a traditional. And then what's nice about both of them too, or the differences, is with a traditional IRA, when you want to withdraw and you get to 59 and a half or beyond, so you're not penalized.
Right.
Okay.
And minimum of 5 years in the account.
I'm sorry, what?
And the account has to be open for a minimum of 5 years.
Very good,
So,
very good.
there's a couple of different things. So definitely look into the specifics of each type of account. Absolutely.
What we're discussing is the overview. IRAs, and you know this, just the distribution rules are a nightmare.
Yes.
But there are some important differences as we're talking about income and or certain rules that your tax person should be aware of, or your financial planner. But again, when you get to where you're withdrawing from a traditional IRA, the bad things at that time is it's taxable, and then you must take out by age 73, you must distribute. Again, looking at the Roth IRA, you don't have to take out, and there's no minimum distribution rules. And when you take out, it is tax-free. So you will see sometimes articles that should you have one or the other. And so I'm saying in general, if you can take out the Roth, do it first. But there could be circumstances, if you run the numbers, that maybe a combination or traditional might be better. But that's the whole point I'm going to make here, especially when we've talked about compounding interest, making the best financial decisions. Run the numbers. Most people make decisions from their gut. I think this, and by the way, if you're ever dealing with a professional, I don't care, an accountant, a wealth advisor, investment advisor, if they're saying my gut feeling is, worst words in history. It should be like, I've run the numbers, and this is what you should be doing for your circumstance.
For your circumstance. That's the whole thing, for your circumstance. And everybody's situation is different. What you need in your portfolio at 25 is not the same as when you're 35 or 45 or 55. So the same way the budget should be updated, your financial plan should be updated as you grow in your career as well. So, but diversification is the key. And that's where that term diversification comes. It means, having those different buckets of tax-free, tax-deferred, tax advantage, and all of those. And if you're not working with someone who's using that terminology, run.
I agree. But let's go back to the cash maximization for a minute. I'm sure you see this, especially in dealing with younger people and with older too. Most people, when they're saving, focus on rate of return, where to put their money to get the highest rate of return. And quite frankly, that's the worst thing to do. I mean, to me, you want your money when you're saving it to take advantage of compounding, to be in something that's steady, and you don't want to try to hit home runs and risk it highly. But basically, especially in ages when you're in your early 20s all the way through 40, 50, you want to be concentrating on cash maximization. Where can I find more cash flow to put away in these things? Not the best rate of return. Some other ways, especially with people, younger people especially, there's a lot of times these people have a good amount of student debt. And again, sometimes, especially depending on who you're getting this debt from, Sallie Mae or other lenders, they want you to pay it back in so many years. But I have found out that sometimes that's negotiable. And sometimes instead of having to pay this loan back in 3 or 5 years, you can pay it back over 10 or 12 or 15. Now, what does that do? Now, again, I'm taking a sort of different approach to debt here. I'm saying when you're first out of school, you can put all your money to paying down your debt, but I think you should be doing the least amount. I think you should be stretching out your debt and saving the difference in your savings to take advantage of compounding. I've run the numbers, and basically, if you do that, you start to get your wealth to where you hit compounding sooner. Not only that, especially in your early years, or if you're newly married, you are safer. Rather than having all your debt paid off and no money, you have wealth or money to fall back on if you lose your job, because the emergency that comes up. So I guess my next thing in cash maximization, there are these cardinal rules out there some advisors have, like pay off your debt first, then save. That, those rules do not fit for everyone. And I think that you must run the numbers, because you may find you're making a mistake by doing that, or that there's advantages in cash maximization for you.
Right. I mean, it's possible that if you have some debt out there, that you can transfer the debt to a 0% card for 12 months, and you can do that. And that way you're just paying that off and putting money away. So there's definitely different situations for different scenarios.
Well, let me give you another tip too. Let's say you have a person who has been worked for almost a full year for a person who has a company has a 401k, and you haven't been put in your match, but you'd love to do it, and you want to put in the maximum by the end of the year. But let's say it's November, December, and you need to come up with $6,000. Well, I would tell you, especially when you know I'm going to get my bonus the first quarter of next year, I
Mm-hmm.
would take that out. I would take the 6,000 off a credit card.
On a cash advance.
Oh, put that in.
Absolutely.
I get my 25% tax savings. I get my match, and then I pay it
Mm-hmm.
off the first quarter of the next year.
Absolutely. Uh, makes perfect sense to me. Same thing when if you're first buying a house, don't take $5,000 out of your savings account and buy a four-piece kitchen thing that you need. Go to Lowe's, go to Home Depot, go somewhere, get the four pieces, 0%, 18 months. Why would you take your money out?
Excellent idea.
So there's a
There's
lot of
so
different tricks out there. So
No, there are. And by the way, going back to IRAs for a minute, especially since I know you deal with a younger audience, and they might have a mother or father that someday they know they're going to transfer some sort of money to them inheritance, well, or they want to give them gifts every year. Well, I would tell your audience, go to mom and dad, say, you know what? Instead of giving me the money and a gift, give me the money to put it into my 401k, put it into my IRA.
right.
I'll tell your mother, look, if you can put $7,000 in my IRA every year, this is going to transfer your estate slowly. Plus, it gives me the gift of compounding, make sure that grows for me.
And tax advantage on both sides for that.
We used to also, if a person, if we had young people, especially whose parents were self-employed, we say, you know what? Why don't you talk to mom and dad, have them put you on the payroll somehow, or have you pay something to again qualify them either for the 401k of their parents and or the IRA, an IRA for themselves.
Absolutely. This has been great, a lot of information, but I do want to get into Cake Club and how
Okay.
that started. So yeah, like I said, there was a lot of things to talk about. So I do definitely want to get into Cake Club. How did that start?
Well, again, after being in the business for 40 years and then writing 2 books, actually I post a post on LinkedIn every week about finance or my experiences in life, and I had a person, a young man in his 30s, who contacted me and said, "Al, I'm a data scientist. I love your books, and I want to help you create an app that basically helps people." Because he was out also to help change the world. He wants to say, I want to bring financial literacy to more people. I want to show people that they can basically achieve their financial plans, live the life they want to along the way. And I want to do this app. So I met with them and I thought, wow, that's pretty neat. And so we founded the company and we started building Cake Club. And Cake Club is there for 2 reasons. One, financial literacy, help you budget. And the first iteration is coming out in about a month. Basically doing
Very
that
cool.
and making sort of a game out of it. But also, we have a part of this app that allows you, if you put in your credit card information, not your total information, just the kind of card you have, so that no one can get attached to your information. But we'll tell you if you're going to go to Target or Home Depot, whatever, which card to use to get the maximum cash back or the maximum points. So in other words, is our way, again, as the way I always did it, how can I find more cash flow for you? So we're trying to find more cash flow that way. And then we're eventually going to have other parts that allow people to be educated more on how to find more cash flow in everyday financial decisions that they have. So that's what we're doing now. And by the way, we're going to be marrying this with AI so that we'll have what they call co-pilot, that basically if you want to ask me a financial planning question, they'll load all my information, my 400 or more articles over my career, my books, and actually Al Zdenek will answer your question.
That's awesome. I'm really excited about that. Definitely keep me posted on this.
Well, I sure will. And by the way, we may have like guest people like yourself that may have an idea or an interview,
nice.
So that we can get to that audience also.
Okay, that sounds really good. But yeah, the use of AI is just so important because it's, you talk about it reshaping budgeting, but it's reshaping so many things. And I
Yes.
think the key is how to use it, how to integrate it, because it's not going away. So, so definitely
Well,
being able
I
to
agree with
utilize
you.
it.
I think the first step is that people saying, I think I need some financial help, and then what's out there. And then they're going to bump into all these things. And again, AI is going to help them. But it all starts with recognizing that you need some help or some education to make the best financial choice.
Mhm. Absolutely. And I mean, you said you started out as a CPA and you thought you knew about finances, and then you went into wealth management. And let me tell you, I spent 20 years in banking and finance and 10 years in academia, and I, I do taxes, and there's always, always, always something to learn. Especially with everything changing. So it's a lot of information out there. And I think the key is to be careful of the scam emails and the scam texts, and talk to a reputable person, get a referral, look out for things like that.
And I'll say beware of just general advice.
Absolutely.
General advice is a first, like, okay, how does it apply to me? But most general advice does not apply to the person. It's your particular situation, your job, what decisions you're making, what's important to you. So just be aware of that too.
I'm sure you get that all the time, and I get people that ask me all the time, well, what should I do? I don't know, because yes, we're friends, but I don't know your personal situation. I don't know how much debt you have. I don't know if you have good debt or bad debt. I don't know if you're leasing or purchasing your car. Like, so I can't just say do this, because there's a lot more information that goes in there. So
Precisely. And what applies to you and maybe your spouse doesn't apply to your friend. So
absolutely.
your friend can say, look, I'm doing this. Why aren't you doing this? Well, it may not apply to you, or maybe there's a better way for you. So I think you're right. It all begins with knowing I want to know more about this, but then how to say, just drilling down to basically eventually having your questions that apply to your personal life
Mhm.
answered for you.
Absolutely, because you can have, let's say, two couples making the same amount of money, both renting a home. One wants to save for purchasing a home, but the other one wants to save their money because they enjoy traveling.
Right.
So, same situation, same income, but different goals on both sides. So, how do you maximize the cash flow for each one of them so that they can get what they want? So it's definitely not a one size fits all.
Never.
Anything else you want to add before we close up here?
One thing when you were saying that about how people, like one couple is not the same as another, I had a post just go on LinkedIn today about budgeting, and I made it a funny thing, like, oh yeah, we look forward to sitting down and reviewing our bills with our spouse. Yeah, right. you know,
Hmm.
like how one may apply to one person versus another. Even budgeting is different. You may have someone who wants a detailed budget. You may have someone that has a more loose budget. It's whatever works for the couple, but it's very important. I've learned that a couple, even them, they may have to together decide what they want. And just because one person or one couple is doing it, don't get fooled that you and your wife or you and your spouse can do the same thing. But and there's
Absolutely.
many, many different ways. It's like leaves on a tree. There's many ways to approach that works for you and your spouse.
Absolutely. And it goes back to what you said, first on. And even when I'm working with someone, if getting that $5, $6 cup of coffee a day is important to you, well, that we need to fit into your budget so that you can
Definitely.
have that, because you don't want to deprive yourself. That's that's not good either,
Well,
because it's just going to become a regret and a resentment.
if you're dealing with someone that's telling you that you punish yourself like that, get
Mhm.
someone else.
Yeah, I so absolutely, totally agree. Thank you so much. So, as we both stated, no matter where you are in your career, you deserve to have representation, and we both pride ourselves on working with people, either just starting out, where it can be difficult to navigate what is definitely overwhelming. You can look out for Al Zenek's book, Master Your Cash Flow and Master Your Business Cash Flow. And if you haven't purchased my book yet, you can get a signed copy directly from my website. And it is also available on Amazon, Barnes & Noble, and other retailers.
As
So
mine are too, yes.
absolutely. And both great gifts for the graduate in your life. So if you have someone graduating, really good information there. So be open to learning, be open to listening, ask questions. What more do you want to know? Visit my website at your18nowwhat.com and drop me a line, send a question or a comment. And any questions received will be responded to by either email or addressed on the next podcast. Remember, be invaluable for what you share, not what you know. See you next time on Your 18 Now What. Be sure to visit my website where you could always find the latest podcast episode to listen to, follow, share, and subscribe. Thanks for joining me. I appreciate you. Thank you so much, Al. It's been a great conversation.
It's been a delightful podcast, and I appreciate it. Very valuable to your listeners.
Thank you.